Hey traders, this is your Show Me the Money trader, and today I want to do a little discussion on multi-time frames. Multi-time frames, if used improperly, can definitely lead to indecision and uncertainty, and definitely cause you to miss trades by hesitation. These were definitely one of the battles that I had to overcome, was find a time frame that works positively in my favor. I wanted to find time frames where I can apply rules to each time frame so that this will minimize the time that it takes to process to decide if I want to enter a trade or not. What I have found to work very effectively is using time frames with the same incremental bars between each time frame. And what I mean by this, when I learn something, I like to learn it one time. I don't want to relearn something over. So me as a SMTM trader, what I like to use is the 1 minute, the 5 minute, and the 25 minute. What do these have in common? Each time frame has a difference of 5 bars. So with this enacted, this allows you to move up or speed down your time frames. You can use the 2 minute, the 10 minute, and 50 minute, and the same plan will work on the 3 to 15 to 75, and the daily, the weekly, and the monthly. Now when it comes to the monthly, you're right, it can be 4 weeks within that month, but it's pretty much the same concept, so 5 time frame, 5 bars between each time frame. The main purpose, one purpose of this was I didn't want my time frames to be too close to each other where I'm seeing duplicate information. Why do I need to see duplicate information? So I wanted to have a purpose. I needed enough space in between each time frame so I can let a pattern evolve. The 25 minute is what we call the higher time frame. The 5 minute is what I call my primary time frame, and the 1 minute is what I call my entry time frame. And the same applies to below. You have a higher time frame, a HTF, a primary time frame, which is a PTF, and an entry time frame, which is an ETF. And I'm going to go through this kind of quickly because we are on a time limit with YouTube. And what I'm going to do is isolate each time frame and show you how to apply rules to the time frame. Well, one thing that intraday traders use, or a lot of traders use, is what they call the top-down approach. But the real question is, especially when you're intraday trading, at what point is the top? Is the daily, the weekly, the 60 minute, the 30 minute? And the more time frames you look at, technically you should have some type of rule for it, even if it's something simple, even if it's picking a daily saying the bias. With this, my 25 minute, my higher time frame, or whatever my higher time frame is my universe, and I'm trading within the boundaries of that universe. So since I'm trading, this is where I derive my information from. I might look at the daily in the morning at the open just to see where it opens up at, but there is no specific rule, or better yet, I don't have any rule in relationship to the daily, because my intraday is going to give me a reaction. Before the daily can change, it must change intraday first. So this is still going to give me a signal. And of course we must have insurance, which are stops. We need an effective way to manage so when you're wrong, which you will be wrong, it is a byproduct of trading, is being on the wrong side of the, well, not necessarily the wrong side of the trade, but having stops. So here I have these 3 charts. These are set up for illustration purposes only. So this is not set up on how I would have my screen set up. So I just put this here just to fit them all on one screen. So I have my 25 minute, my 5 minute, and my 1 minute. So since we're doing a top-down approach, our top here is the 25 minute. This we're going to base rules on. Our 25 minute is basically our higher time frame. This is going to be used to give us momentum and direction, and to plot support and resistance. But before I go on, I just want to add one more note here. Using these time frames the way I do them, it's ideally when you're trading 3 instruments or less, and even more ideal if you're trading the same instruments over and over, because this allows you to understand and mark these charts up and use prior areas from the day before if trading within that area. So the first thing I do is seen here, these areas, these blue areas, are what I call supply and demand. I mark these areas, and this is my SMTM line, area where buyers have showed me the money. SMTM, show me the money, and that's what I like to buy at, areas where buyers have showed me the money before. And we wait for price action to confirm these areas. Of course, this area above is supply. We have an area below, as right here, this area was an area of demand. And so then I have my specific rules for this time frame. Once I have this time frame and I plot these areas, I minimize this chart. So now this is finished. We don't need to look at this chart anymore. What I have for me is software called Say the Time, and you can set that to go off at any particular time you want to. So for using this time frame, mine goes off every 25 minutes to let me know to look at that time frame to see if momentum changed or has any other information changed. But I take that same information and I plot that onto my primary time frame chart, which in this case is the 5-minute. I'm not going to go too deep into resolving supply and demand at this particular point, but to keep it simple, here we had a pivot here which resolved this area. This was a push and attempt up, and this was all that this supply had. It ran out of gas at this point and it just failed, and it had room to fall because there was no more supply here. Once this pivot formed here, then this I'm sorry, not supply, this is demand, area of demand. And here, this is the area of supply. And once this pivot formed, this area of supply was resolved. And I have that marked accordingly on my primary time frame. So this allows me to focus strictly on my primary time frame for technical analysis, to find entries, which way it's going, because I have my direction, my momentum from my higher time frame, my direction I want to trade in, and I'm continuously checking on that for 25 minutes. But what can happen if you're steady watching your higher time frame and your prior time frame, your primary time frame, you can see your higher time frame might be going down, and you can find yourself hesitating to enter a trade because this is a big red bar on your higher time frame, which is my 25-minute, and that can make you hesitate to enter a trade. So once you make an objective decision on that higher time frame, that's it. You just need to go to your primary time frame to do analysis. And this approach is taking one time frame at a time, so to keep down the confusion. What I like to also add is information on this chart. Real quickly, I don't use red and green bars. My bars are what I call static and dynamic bars. All the white bars are what I call dynamic bars. This is when interest came into the market. All these other bars are what I call static bars. This is when it's not interest into the market. Real simple. The ideal is to enter on static bars and exit on dynamic bars. That's to keep some. That's the purpose of static and dynamic bars. So you can see if I look at this as a red bar, or certain areas coming down. When it's a bullish market, if I see red bars, this will have me maybe thinking twice on getting in. But when I see this white bar, I know, okay, that's money into the market. Okay, this is time I should not be entering a trade on this bar. So this just warns me to let me know the interest is already here. Let me let some static bars form, and I want to be in on the dynamic bar. Now that's covered. Let me go back to the multi-time frame. So once I mark these areas and I see that my supply stopped here, just as I marked on my other chart, and I see that my demand stopped here, I don't need to look at my higher time frame for that. And now I put up my 1 minute. Let me rephrase this. Ideally, these are just, I don't need to look at these. Now I have my 1 minute up. Now there is one thing which I will do. I will have my 5 minute and my 1 minute up side by side. This 1 minute is my ETF time frame, my entry time frame. So now my focal point is just on these two right here, timing it for my entry. I don't need to constantly look at my 1 minute. The only time I need to look at my 1 minute if I'm at, say, a SMTM area, which is a supply and demand area, or SMTM line, and then I need to look at my 1 minute to see if there's a point of entry on any of these. If not, I just wait, and if no setup occurs, no problem. I close my 1 minute out and I just focus right here on my 5 minute until my, say, the time goes off, 25 minute goes off. Then I go ahead and I just focus strictly on this 25 minute, see what it's doing, to see if I have a new direction, if anything has changed, and then I go right back to my 5 minute. I believe any time frame that you look at, you need some type of rule for it. If you don't have a rule for it, why are you looking at it? Because if you don't have an objective rule for it, all it's going to do is lead to uncertainty, because you can come up with a new thought process every time you look at a different time frame if you don't have a consistent rule and a consistent purpose for looking at that time frame. So using multi-time frames can be a tremendous benefit. And one other note I'd like to add, the reason why I don't use 5 minute, my primary time frame, support and resistance, because if my higher time frame is, if it's really resistance here, it'll be supply and demand on my higher time frame. So that's all I need to know. If it's supply and demand, so I don't need to mark major resistance or major support based on 5 minute information. My 25 minute is my universe. This is the boundaries that I'm trading in between, whether I'm trading in between this bar or whether I'm trading in between these areas. Now, with the time frame being 5 bars apart, I can even trade in between bars. Why is that? An intraday trader is looking to get maybe a 2 to 4 bar move on each move. Now it could be more, but that's maybe the average. And so I have 5 bars in between each time frame. And so as I have, my primary time frame has a 5 bar difference between my 25 minute. So I can buy, as example, down here at this area and exit up here at the top, because I'm only looking for, I'm trading just in between my universe. So I don't want to look too far in the future and try to focus on what the overall momentum can be. The daily can be somewhat of a bullish day, but you can have a lot of turns in that daily bar. And so if I'm waiting just for a certain play to happen in the daily, it can be a longer wait, but then I need to accommodate it by holding for a longer time period. So your trading style and your risk management should go hand in hand. That's very important. Okay, traders, I think I covered the basics on multi-time frames. So until next time and next lesson, traders, GT, good trade, and I'll talk to you later.